Welcome back. Indian stocks in general and the Nifty Bank in particular have plunged into the red following Asian markets and probably as a result of the strong dollar and US yields. But the bank stocks are also reacting to the early Q3 deposits and advances disclosures. For a majority of the banks, deposit raising has been a struggle, and the way the early data is showing, it looks like NIMs or margins are going to be under pressure when the full results come. For HDFC Bank, it's the other way around. It appears that not margins, but the volume of loan growth will be a bit of a letdown. To analyze the early numbers from banks, I have with me Santanu Chakrabarti, the head of banking and finance company analysis at BNP Paribas. Santanu, good morning. Thank you very much indeed for joining us. And well, it's still the first week of the new year, so a very happy new year to you and everyone at your company and your family.
Thank you, Latha. Good morning and a very happy new year to you too. I just heard you speaking about the deposit numbers, and just looking at liquidity in December, you'll see where those numbers are coming from.
Oh, absolutely. It was tight liquidity. But you know what? Since the market is more preoccupied with what is dragging down the indexes, I'll begin with HDFC Bank. It's not the one that's lost the most, but willy-nilly, even if it is in the red, it pulls the Nifty Bank a goodish bit. What have you made of the numbers? That 3% loan growth is after having sold off 46,000 crore of loans this year. Otherwise, the number would have been different.
I mean, otherwise also on their base, the number doesn't look blazingly different. And frankly, the loan sale downs tell us more about their approach towards, profitability and pricing consciousness, rather than have a material impact on the size of the balance sheet at this point. This was true of the, mortgage sales that they did in the first half, and it remains true even at the end of the third quarter. It gives us a sense that they are very cautious that the money that they're raising incrementally is high cost money, and therefore the asset uses it should be put into should be commensurate to the cost of that money and the nature of that money. So for example, in this quarter's early release also, Latha, you'll see that their focus the growth has been primarily in what they call CRB, commercial and rural banking, and retail, and wholesale, which is corporate, essentially still continues in shrinkage mode, and that follows the plan to a T. Having said that, is 0.9% quarter on quarter a low number? No doubt about it. But the interesting thing
my point is, Shantanu, the question I have about HDFC Bank is, first, what do you expect their margins to be? My sense is the margins are going to be as good or better than the previous quarter. But ultimately, EPS or profit is both volume and value. So margins are high, but volume is going to be low. So what is your EPS forecast, RoE, the entire? How do you approach the bank?
Right. So, in this part of the interest rate cycle, the cost of funds for most banks have kind of matured. So RoE, margin erosion, to start with, which drifts down into RoA and RoE, is not material for any of the major banks. HDFC is a special case where HDFC, because of a very, somewhat irregular liability structure that it's coming off and it's gradually rationalizing, you might actually see, even better performance on a sequential basis on margins vis-a-vis other banks, right? And now the moment you see that they have been able to move deposits up by 2.5% sequentially, not a large number, but a meaningful number, a 64,000 crore number is not small in the context of what's happened in the system in the last quarter, especially in December.
Fair enough.
And in that context, I think, the margin surprise, which the market reacted so positively to last quarter, that positive margin surprise could come through. Now, I hear your point around how profits are ultimately a function of both loan growth as well as margins. But I think in HDFC's case, especially if people have a price to book prism on valuations, they're trying to figure out what steady state margins and therefore ROAs and ROEs look like. And better and improved optics on that on a sequential basis, I think is going to weigh heavier than, what the EPS number looks like.
Okay. So what would your price to book forecast be for the year? And I think you have the biggest price target on this street, 2,550. Right. Yeah. Okay.
Right. So, look, I have still some way to go before re-rating it back to what it used to trade at. But I'm just saying that at 2.1 time price to book, it's probably, if you strip out the subsidiaries, it's probably trading at a valuation that better suits a wholesale lending NBFC than a retail dominant bank, even if it's with low CASA. And therefore, my target multiple is around 2.8, right? And that gives you that much of upside. And I think the path to achievement of that multiple is that margin improvement and therefore consequent impact on RoE.
Okay, fair enough. Let me quickly look at the other banks. More generally, what have you taken away from all the other private sector banks? We don't have too many of them. We've got IndusInd, RBL, CSB. Many of them are smaller banks. The big Axis ICICI are not out. But what have you made of the private banks? I'll come to the PSU in a bit.
And so, the one which stood out for me was IndusInd. So IndusInd's growth number, now I can understand there's some stress in the MFI sector and it's hard to make a segment commentary at this stage from the early releases, but the numbers on both assets as well as liabilities looked a little lackluster, to be honest. And there's a takeaway from there as well. And Bank of Baroda has also put out numbers today, and their growth is about 9.5%. Yeah, I heard the previous anchor was also speaking about Union Bank. So, their numbers have not looked great. So overall, I think the tightness of liquidity is starting to bear down on deposit growth. But what is quite interesting, Latha, is at least the CD ratio aspect of it is no longer a topic that seems to be in play. Because if you look at the last fortnight's disclosure, you'll see the loan growth and deposit growth, as we had expected, has exactly converged to 11.5%. I think easier liquidity is required.
Yeah.
And that's perhaps required even more than easy market.
I would assume
for
we
the
will
growth
hear
to
of.
accelerate.
Yeah, I agree with you. I think we will hear of OMO, OMO purchases by the Reserve Bank, and probably at the lower end of the curve, not at the 10-year, but definitely at the lower end of the curve, there will be liquidity that they will provide. But there is a separate story on the kind of pressure we are seeing on the currency. On Friday, the Chinese PBOC has allowed the currency to go beyond 7.3. And today, the offshore currency is 7.36. So, we don't have too many options. We will have to let the rupee go, perhaps. And right now, as I speak, 85.80 has been given up by the Reserve Bank. They seem to be protecting it last week. Today, they've given it up. Okay, coming back to NBFCs, then I'll come to the PSU banks. What's true for you? Bajaj Finance, winner all the way?
5 million customers added, Latha. I've been looking at this. It's my top pick in NBFCs, okay? But just,
even at this price,
irrespective of what view you have on the company, to look at that and appreciate. In this environment, to add 5 million new customers, it is a stunning achievement. And their growth is tracking. Now, there's no comment around asset quality. But if asset quality pressure was a major concern, would they have grown at 28?
Okay, any PSU bank you like?
So, SBI, we have just gone to neutral because, the pricing appears a little more full to us at this stage. But we like the setup. There's nothing wrong there as far as we are concerned from a business perspective. But just that relative to what we have available on things like HDFC Bank at this point, we have moved to a neutral on a sector basis because our recommendations are sector relative.
Okay. What intrigues me is I think you have a coverage on SBI cards. That still remains underperformer, right, for you?
Right.
I guess
yes,
likely
it does.
so.
Yes,
Okay.
it does. The regulatory pressures and the business has structurally changed. I don't mean just the SBI cards business, the credit cards business. The revolvers, a lot of them have become essentially EMI customers. And even in a period where you're seeing some stress, you still do not see revolver behavior, right? So something has fundamentally changed about that business, with implications for profitability and ROE generation capability of that business. Apart from that, all the regulatory overhangs continue to exist. On top of that, when I see valuations which are probably a little richer than Bajaj Finance, it's very hard to make sense of them on a relative basis.
Okay. Overall, how does BFSI figure for BNP Paribas? I mean, this is, of course, your strategist question I'm asking you.
Right.
But you tell me, what do they think? Should we even chase banks? Or should we really wait for even 6 more months for liquidity to return and banks to get more comfortable?
Right. So the BNP Paribas view throughout the last year has been, that we have preferred banks and IT. That's what our strategist Kunal has preferred. Now, within banks, not much has fundamentally changed, right? I mean, maybe in the beginning of the year, if we would have thought about a September or a December cut, and now we are talking about a February cut. But other than that, if you look at the overall setup of the business, nothing has really changed. And I suspect that, therefore, banks will continue to, feature prominently.
Let me put it this way. Let me put it this way, Santanu. Have deposit costs peaked? Have margins bottomed? Or you think there is more of margin erosion left to come? And for how many quarters?
So the answer to that is, as far as our pre-cut basis is concerned, both of those things have happened in a material sense. I mean, 1-2 basis points here there is different, because what were the costs hardening from? The costs were essentially hardening from the repricing of the FD back book. Now that is done. If you look at the existing FD books of banks, what their implied yields look like, and the incremental pricing on which they're raising FDs, they're both at par. I mean, for most banks, that's about 7.25%, right? Okay. And so incrementally, the only pressure on cost of funds is the extent to which FDs increase in proportion of total funds. That's about it. That's a couple of basis points here, there. Okay. What happens is margins actually bottom after rate cuts, because remember, a very large part of the loan book is repo linked. And a slightly larger part will become repo linked the moment rates get cut. I'm talking about top corporate exposures, which will go to the lowest rate. So the margins bottom after that. From that point onwards, you have stable to slightly improving margins, which creates a great earnings growth setup for FY26.
So in short, margins still have to suffer. And it's only after the rate cuts that we are going to see them improve. For broadly the sector, exceptions notwithstanding.
Right, but correct? Until pre-rate cut, you are not going to see too much of turmoil in margins. It would be around this level.
Okay, got it. Thanks a lot. Thanks a lot, Chandru. Out of time, and we will touch base after the big banks announce their numbers. Thank you very much indeed for joining us. And as we wind down on Bazaar, the markets are still indicating a lot of pain. The Sensex and the Nifty are holding up, but mid-caps quite clearly under pressure. And I think the pressure is coming from global factors. Wrap up on that note. Chartbusters coming up.